but they've really conceded the war because they know that fighting it will do too much collateral damage. So we're going to have runaway inflation. Inflation is going to keep getting worse. Ultimately, that's going to destroy the dollar's role as the reserve currency. And
in recent discussions, economist Peter Schiff has stirred up some controversy by saying, recession is the cure. He believes that going through tough economic times might actually help fix problems in the U.S. economy. Schiff suggests that the government should raise interest rates, which could make it more expensive to borrow money. This, he argues, could help keep the value of the U.S. dollar strong. His ideas have sparked a lot of debate among experts and others who are trying to figure out what's best for the economy. So, let's listen to him again.
You buy gold as an alternative to U.S. dollars or U.S. treasuries. Foreign central banks are selling their dollars and buying gold. And why are they doing that? They're foregoing the interest that they could otherwise earn on treasuries to own a non-interest bearing asset like gold. Well, the main reason to do that is if you believe inflation is going to be higher than that interest rate, that means you have a negative yield and you're going to lose purchasing power if you stay in dollars or in treasuries. And so they are selling and they are buying gold. Look, the price of gold in the 1970s went from $35 an ounce to over $800. Right? That's not a coincidence that happened during the year or the decade of all this inflation. And what gold is doing, but it wasn't gold that was going up. It was the dollar that was going down. Like, for example, oil prices in 1970 were about $3 a barrel. In 1980, they were $30 a barrel. But the difference was in 1970, we paid in gold. In 1980, we paid in paper. And so it wasn't that the oil price was going up. It's the money that we were using to buy oil was losing value. And so we had to pay more dollars to buy the same barrel of oil. I mean, that's why you mentioned women working. This was my comment on women, in the workforce. The main reason that so many women entered the workforce during the 1970s was inflation eroded away the value of their husband's paychecks. And so because inflation caused the husband's paycheck to lose so much purchasing power, his wife had to get a job to make up the difference. Now, part of it was also rising taxes. There was a lot of bracket creep during the 70s where inflation pushed people into higher brackets. But it's not like, women were just all liberated and all wanted to work. They were liberated when they didn't have to work. They got forced to work because it was the only way to pay the bills. Now, the comment I made more recently is that that's how we basically got through that time period. We had a spare laborer. We had somebody who could come off the bench onto the field and help out. And that's how families were able to survive because they now had a second breadwinner. But now you don't have that because most families, the husband and wife already work. So what are people doing now? How are people surviving this inflation? Well, look at the jobs reports that we get every month. We have all these jobs that are being created, 200,000, 300,000. What they don't tell you is these are all part-time jobs. We are net losing full-time jobs, and they're going to people who already have jobs. So people are working second and third jobs. Moonlighting is at an all-time high in America because that's the only way that people can pay the rent or put food on the table. People don't want these jobs. The creation of these jobs is not a good sign. It's a bad sign. It's not a sign of a strong labor market. It's a weak labor market. In a strong labor market, you can make it on one job. In a weak labor market, you need 2 or 3 jobs. And that's what's going on. We have to appreciate the fact that really, in earnest, it started in 2001, 2002, after the dot-com bubble burst, right? That's when the Fed first lowered rates to 1%. I mean, Greenspan made a lot of policy errors in the 90s as well, and that's kind of why the stock market bubble got as big as it did. But the policies really, went to, the sublime in 01 and 02 with the rate cuts that gave way to the housing bubble, which led to the 08 financial crisis. But every time the Fed creates a misallocation of resources, malinvestment bubble, every time it pops, instead of allowing the market to fully correct for all the mistakes that were made in the past, right? The recession, as far as the business cycle goes, this boom-bust cycle, the boom is where the mistakes are made. The bust is where they get corrected. And you have to allow the market to do its job. But in the short run, that's painful because people lose their jobs, they lose money, and the voters don't like that. So there's always political pressure on the government, the Fed, to try to fight a recession when the recession is the cure. So fighting it simply makes the disease worse. But what they do is they keep creating more inflation, and it's kicking the can down the road and postponing the inevitable pain. But every time they do that, they make the underlying problem worse, and therefore the ultimate pain to resolve it, right, worse. And so my point is we are now at the final, like, crossroads where the Fed has to pick the lesser of two evils, right? So on the one hand, it can fight the inflation that it created, with QE and all this, the expansion of its balance sheet. It can fight the inflation. But to do that means interest rates have to go much higher than they already are. They have to go high enough to force massive cuts in spending on the government level and on the household level. But our whole economy is based on spending right now. It's a bubble. And so they have to create a massive recession. It's not that recessions are necessary to fight inflation. It's just that what's necessary to fight inflation will also cause a recession because of the underlying nature of the economy. And this recession, which will have a housing market crash, a stock market crash, will result in a wave of defaults and failures. There can't be any bailouts like we did in '08. So when a bank fails, they can't bail it out. They have to let it fail. And they have to allow the depositors to lose money. There's no money to bail out the depositors. They have to lose. The government has to tell people on Social Security and Medicare, we just don't have the money to make the payments. We're not talking about making cuts for people in the future. The checks we're sending out right now, we don't have enough money. We gotta make those smaller. Right? Social Security, the trust funds, so-called trust funds, are already selling treasuries right now. Social Security already takes in less than it puts out. It's insolvent. So the government has to tell government pensioners, we can't make the pensions because we're broke. We actually have about a $3 trillion a year deficit right now, maybe closer to 4. I mean, even if they massively increase taxes on the middle class, I don't think there's enough they could do it. So they have to make these deep cuts to government spending. And of course, that's going to be very problematic for people who were counting on Social Security or who lost their savings in the bank. In fact, if the Fed really fights inflation, we probably can't pay the interest on the national debt because right now we're spending about $1 trillion a year on interest on the national debt. If the Fed, let's say, raised interest rates to where they need to be, given the short-term nature of the debt, within a few years, we could be spending $3 or $4 trillion on interest on the debt, which can consume 100% of tax revenue. And of course, we can't cut Social Security, cut Medicare, right, and pay the Chinese 100 cents on the dollar. I mean, that's just not going to fly. So we would have to default. We would have to tell our creditors, we can't pay you what we owe you. Well, maybe we'll pay you some discounted rate. So all these difficult things are going to happen if the Fed really does what it needs to do. But politically, that's like a non-starter to force all those, tough choices on the politicians. So the other choice they have is, okay, we're just going to allow inflation to keep continuing. Now, they can't say that. They have to pretend that, oh, we've done enough, it's coming back down. But they've really conceded the war, because they know that fighting it will do too much collateral damage. So we're going to have runaway inflation. Inflation is going to keep getting worse. Ultimately, that's going to destroy the dollar's role as the reserve currency. And people are going to see the value of their Social Security benefits eroded anyway. The bondholders are not going to get paid. They're going to get inflated away. So the real losses that inflation is going to impose on all the government creditors, including people, that own dollars.
Thank you for joining us in exploring Peter Schiff's provocative stance on recession and interest rates. The debate sparked by his ideas underscores the complexity of economic policy. Remember to like, share, and subscribe for more thought-provoking content on finance and economics. Stay tuned for future discussions. Thanks for watching.